All right, hello guys, and glad to have you on board again today. Wanted to make a quick update. These are things that I'd like to make on a recurring manner, starting by September or mid-September, depending if I'm lagging on the schedule. But still, these are the things that I'd like to do at least once a week. I've chosen so far to go for Wednesdays mornings, and in that perspective, I would try to do this around once a week. What this is all about is that on the weekly updates, on TradingView, we're generally having and paying attention to daily and weekly chart references, and we rarely dip below shorter time frames and stuff like that. There have been some requests from the French community saying that there was a serious lack of actually tradable content, because of course looking at daily to weekly charts will probably gives you no more than a trade each month. But as usual, I'd like to explain why. I'm not here to feed you, and I definitely don't want to. I hate people who do this very profoundly, so I would be dumb to do the same. So the thing is that I had to find some kind of a middle ground in which I will give you more real-time tradable signals and contexts, whilst in the same time certainly don't feed you with market trades and real-time trades, because I want you guys to work your way into trading, not just opening the fucking mouth and being fed up. So that's the narrative behind the decision, okay? So we're going to try doing this once a week on this H1 to H4 reference time frame, so just shifting one way below, and this should normally give you a tradable signal on a weekly basis. It should give you one trade each and every week normally. So that could be a good example to start practicing the strategy itself. Once again, I'll just show you the examples. Go feed yourselves, okay? Look at charts, find some trades, recognize some patterns, wait for signals, trade, and repeat. Okay? Anyway, so despite that, if we want to make some intra-weekly things, we might want to pay attention to timings. And in that perspective, I recommend to have a look at this. Figure out what is going to be the major weekly catalysts, and in that perspective in here, it is clearly the PCE index, which is the Fed's reference for inflation, and right after the cherry on top, Fed Chair Powell will speak. So this is definitely a week that will oscillate across Friday's close. Okay, when you have that types of weeks, generally what you will end up with is two scenarios. Either the market will hesitate all week long and will break out of the range as the catalyst is released. So we're gonna kind of an accumulation week in which the Friday will break up or down depending on the catalyst. So we will build range that will concentrate accumulation across the release of the energy, the big catalyst. Option number two is that you will get the opposite. The market was going on an opposite direction, and generally what you will get in here is the entire week building to retrace, and then it's going to be kind of a sell the news, meaning that the traders will buy earlier in the week and they will take their trades off as we get closer or as we get to the release, meaning that the information will provide kind of a sell the news event. So traders will buy by anticipation and sell at the release. That's a general classic when the catalyst is on Friday, because for multiple reasons, traders still want to have a holiday, still want to have their weekends, and in that perspective, they generally don't want to handle risk taking of having a gap in Monday or whatsoever. So they take their profits on the tradable sessions, meaning that they generally buy at the end of Monday or early Tuesday, and they generally rally all across the board till the release of the catalyst. So this is the reason why we need to make those analyses very quickly. Though I think in the week we're experiencing now, we have severe chances to see an option 2 scenario. Though we'll see all about that when we look at the charts. Okay, so first of all, we're going to have a look at the euro dollar, because this is the current big gainer which everyone is talking about. So quick recap: even though you trade on shorter time frames, always pay attention to whatever happens in the higher ones. Okay, so just as a quick reminder, euro dollar is trading on fucking yearly Bollinger Bands, which are closed like crazy. These are the ones you see here, okay? So the volatility on a yearly basis is contracting, yet people are gambling and betting on the opposite direction. We're already freakingly oversold at the end of a bear cycle. We have all the necessary signals waiting for a price reaction. So all I can tell is that this is a matter of month, but if we ever have a bullish month in euro dollar, that's gonna be nasty for those who sold. Okay, so selling euro dollar on closed volatility boundaries is absolutely silly type of risk limitation. We don't trade against those volatility boundaries like ever. So in here, it's buy only. The question is, do we buy out of nothing just like that because the volatility boundary is here? Just buy and close your eyes. No, it's not the case, okay? But we need to pay attention. The reason why I'm looking at the monthly chart time frame, even though we've said we will only trade H4 and H4 context, is the fact that on monthly Bollinger Bands, fuck, you don't sell. Okay, so there is no selling activity possible in here. We will only accept buyings. So buying opportunities, there was one. We've got a third range boundary context in here. This is a bear trend, or at least prices are trending. So in that perspective, all we can tell out of this thing is that we've reversed the context. So normally there should be a price taking profits, meaning that those who follow this trend should lock on their gains. The question is, how would they do it? What we can see is that there's absolutely no third range boundary tradable signal. We've just flushed all across the context and just gone in a straight line with severe overload. And there's still no signs of bullish reaction. We've already retraced down to the double bottom area, meaning that this is no longer tradable, or at least in my personal opinion, trading double bottoms as well as double tops on third range boundary contexts certainly doesn't provide good risk-reward ratios. There are still profitable trades. If you trade thousands of these, I think you would still be profitable by the end, but by a far lesser margin than if you would trade on more regular contexts when the market is not retracing to the double tops and double bottoms. So in that perspective, I would say euro dollar, sorry folks, this is a no-ganger. Like we said, we're only looking at buying opportunities, but there's none. So sorry, but we're going to have to move away from this one. If you absolutely want to trade euro dollar, there's one thing I can tell. Just get the hell away from here. There's nothing to trade. Pass on that trade. If you look for tradable signals, look for the lowest risk opportunity, not just trading what you want to trade. So if you want to trade euro dollar, sorry folks, the technicals are shitty. Get the hell away from here. You could eventually try to look for USD GPY instead, which is far better. As you can see in here, same thing as a reference perspective. Just give it a second to plot. Yeah, I know it because I just did it for the French guys. But yeah, third range boundary in here, folks. So same trend, but on the opposite direction. The market reverses the context and pulls right back up in here. We're trading at 76% retracement. The market has made no closes above the context for now. And we do have overload and overbought cluster signals. And the algorithm has detected a bearish third range boundary. So that's much better, right? If this one holds on and if the market reverses inside the context, then the target is to retrace down to the opposite range boundary in the previous bottom and to break it to find a profit taking in this nearby area below the previous low point. So in that perspective, in here, the risk-reward ratio, definitely worth it. In that perspective, you know how to use the trend channel as a stop loss sizing, meaning that your stop loss is pretty much in here and you're selling with a target in here and a risk limitation there. Your validation will be the trend channel in here, meaning touching it allows you to lower the stop loss above the market top and just reduce your risk to near zero, not zero. Remember, don't fucking put your stop loss as a break even. Only the noobs do it. Okay, so that's one thing. As for example, today, trading euro dollar, if you want to trade against the dollar ahead of the PCE, well, in that perspective, trading euro isn't the smartest choice to make. You rather like to trade against GPY, which offers much better risk-reward ratios and much better signals to get into these trades, okay? So that's one thing. In terms of signal, of course, remember that if you want to trade inside the context, you want to have red signals. You had one, but the signals that precede the candle close were the gray ones. So in that perspective, I would say the type of signaling in here is not perfect. You do have a cycle breakout, which makes it better, but in that perspective, take it all into account, and I would say you just can't go with a full position sizing. Don't take a 2% risk on that trade. I would say anything close to 1 to 1.5% is definitely interesting, but no more. So you can't go full force in here because the nature of the signals are not 100% perfect, but we definitely have some good factors in here suggesting that USD GPY is building a third range boundary. Remember that third range boundaries are not reverse patterns and things like that. So this is just no more than the market will range. It will have to breathe in and out. Just let it play out. Okay. Other things that might be showing interesting context right now is silver. So let's have a look at another folk. Yeah, same thing. We kind of have a trending behaviors in here. So anyway, moving average has gone out of context. You've got a reverse context. So congratulations, third range boundary. But look at this, folks. So what you've seen is so far Eurodollar is a piece of shit in terms of risk reward ratios. USD GPY is offering better risk reward ratios. And now you'll see how shaded grays play out with the indicators. Just look at silver. Just look at that. How much more gorgeous this is. We are price okay, meaning that we're just waiting for a price reaction. And I'd rather like to tell you that this one will show up rather sooner than later. We're trading exactly inside the context, same retracement as we see on the USD GPY, but look at the difference in here. The signals are far much better, okay? We have taking profit patterns and we've been oversold severely as well. The cycle is clearly at the end of a bear cycle. We do have the same target in here, but the target on USD GPY has been crossed, as you can see. It's been trying to accelerate in here and we've tried to go beyond that. So in terms of positioning, in terms of risks, gradients, shaded gray, this is far better. We do have the attempt to break out. We have a taking profit signal in here instead of the overload that we have right there. So this is pretty good in my personal opinion. We're just waiting for the price to react. So this is more of a matter of time. If silver shows some bullishness today, I will definitely follow suit and add up to my existing positions. The target in here is the target of a bullish range, meaning that's exactly the same as USD GPY, but the risk rewards in here are far better. In my personal opinion, I would never consider putting a 2% risk on USD GPY. I would definitely do it on silver. So in here, on a similar type of context, and all of these markets will probably perform the same way, meaning that there will be no one going up and the other going, one pulling the direction, meaning, for example, you will not get Eurodollar going up and USD GPY going up. They will probably perform similarly, or oppositely in this case. Though all of these scenarios have high level of correlation, you certainly can't trade them all. You might want to choose the best solution. So this week's catalyst is going to be around $1. So try to find the best dollar pair to play against this thing. In terms of pure Forex, I would say GPY is a better option than Eurodollar, but you might want to have a look at GBP, for example, or other major currencies. If you want to go outside of Forex and you want to trade anything that is dollar denominated, well, in that perspective, silver has a much better situation than the other two. So this really is what this is all about. You need to wait for a price reaction on silver, and if it shows up, then that's going to be a good point. Of course, for cryptocurrencies, that's pretty much the same. These are all dollar-denominated assets. And as you can see in here, boy, this is even better. In terms of 4-hour context, as you've seen, silver is trading inside the support context. Well, look at where Ethereum is on the trend channel, barely trading at 50% context. So in terms of bullishness, I would say this is where the game is played. I currently see a lot of people complaining about Bitcoin underperforming the market whatsoever. Yeah, Bitcoin is definitely underperforming. It definitely is. But the stronger right now is stronger for one reason. So it is definitely Ethereum, which is trading what looks like a much more interesting context to me. But of course in here you can trade. Remember, you always trade inside the context. So this one is far more bullish because it isn't trading in the third range boundary context that others might be offering. But these are the ones you can trade. This just tells you it needs to retrace more in order to be attractable enough for risk-reward ratios that you can trade. Though all that tells you is that these ones doesn't sell enough for you to trade them. So, same old story. That means if you want to trade Ethereum, you need to find the lowest risk time frame, but it is not on the 4-hour chart. I hope you do understand that now, okay? Some of you guys want to trade specific assets. If you do this, then remember that what you need to do is to find the best time frame where the risk is the lower. If you want to trade specific assets, don't also add up a specific time frame to trade on. That's generally the #1 mistake. If you, for example, you tell me, Phil, I would like to find a trade throughout the week on Ethereum. The only thing I would tell you is that, fuck no, this is not possible. You're not going to get it. So you might want to invent something, but this is not how trading works. There's no way you can find a tradable signal with my strategy on 4-hour reference time frame in Ethereum this week. Instead of prices going to 1200, which is not going to happen, or at least very less likely. Though that being said, I'm going to leave you guys with that as a quick example of the things that we might be doing on a regular weekly basis starting mid-September. We will just have a look at this. What's the current narrative? What's the next big market catalyst? And what are the best ways to get exposition to this with the same or low risk strategies? We'll of course try to trade against third range boundary context most of the time, because that's the first pattern you guys learn with me. And therefore that's the most generally known pattern for those who look from the outside. So that being said, I'm going to leave you guys with that. See you later.